On this channel, we talk all things dividend. So we talk dividend stocks, dividend investing, specifically dividend growth investing, and much more. So if you're interested in any of that stuff, please subscribe and join us on this channel. The first stock is Smith & Nephew. Smith & Nephew are a multinational UK-listed healthcare and medical equipment manufacturing company. Whew, that was a mouthful. They specialise in equipment and products for orthopedics, sports medicine, and much more. So over the last 1 month, Smith & Nephew have been doing pretty well and are up by 5.58%. If we look at the picture across the last 6 months, though, you can see this is very different, and they're down by nearly 18%. A similar picture, if we go to year to date, we can see that they're down by just under 19%. And then if we look at the 5-year picture, again, we're seeing this miserable picture of them being down by 20%, just over 20% even. So now could be quite a good time to pick up some Smith & Nephew should you be interested in this stock. You can see here that the share price has really decreased. So over the last 5 years, the high has been around 1,965. Remember, that's in GBX. And as of right now, it's dropped to 1,050, just over 1,058. Again, remember, that's GBX because that always tricks me out. And then when we max out the graph, we can really see what's going on with this stock as an overview. So they reached a peak here in August 2019, and since then they've kind of been slowly declining, and right now they're at quite a low point, the lowest point that they've been since 2014 really. So yeah, it could be a good buying opportunity now, and now especially because we're kind of in this weird economic situation where we're hearing about a recession all the time and how everything is, going crazy with inflation, cost of living, and people don't really have as much disposable cash as they may once had. And a healthcare company like this, and like Unilever and these other consumer goods and healthcare companies, pharmaceutical companies, they're more defensive in terms of they're in that defensive sector where they tend to not be cyclical and do well regardless of what's going on in the economy. Another thing just quickly about Smith & Nephew that's interesting to point out, about half of their revenue comes from the US, and then just over 30% of their entire revenue comes from developed markets and emerging markets. So even though it's a company based in the UK, they are bringing in revenue from lots and lots of different places all around the world. Obviously, no one can predict which companies are going to do well in the future, but I think Smith & Nephew could potentially have some good earnings in the upcoming years and upcoming decades. As China specifically opens back up and supply chain and supply issues ease, that could be good for them. And also just with the aging population of the world, it's going to be companies like this that are producing the medical health care equipment that are going to be in high demand. Smith & Nephew are a dividend paying company that pay biannually, so twice a year. Their current yield is about 3.1%. And let's just see how they've been doing. Okay, so they have been increasing their dividends slowly since 2011. Then they've had a dip and they're not yet currently reaching pre-pandemic levels, but it's looking good. They're going in the right direction. Just taking a look at their PE ratio, which of course is just one metric that we can see whether a stock may be overvalued, undervalued, whether it's a good buy right now. It's not the only one, so please, do your own research here. But we can see that the PE ratio is pretty low right now compared to the historical PE ratio of Smith & Nephew. Another thing to point out with PE ratio is you should always compare it to the historical ratio of the same company and then of companies in the same sector. You shouldn't look at Smith & Nephew comparing to HSBC or something like that. It's just worthless. Always look at it compared to the same sector and to itself. The next company, which may be of interest to you right now, is B&M. B&M is a discount store, so as people are experiencing tougher times, they may turn away from the big supermarkets and actually look towards options where they can get more for their money. So they have somewhat of a competitive moat. They have something to offer that some of these larger supermarkets don't actually have. One real strength of B&M is that their debt and their dividends are both covered by their cash flow and their earnings. Just taking a look here, just very overview look, we can see that the total revenue from March 2021 to March 2022 has taken a little bit of a hit and has fallen. And it's the same story for the net income. But you will also notice that the operating income or loss has also decreased. So definitely worth having a look here, and you can also get access to the balance sheet and the cash flows. B&M pay twice a year, and at the moment they're paying a dividend yield of about 4.2%, which is actually a bit lower than the big supermarkets. So if you look at Tesco and Sainsbury's, they are paying in the sort of 5.7 to 5.9 range at the moment. But as we always say on this channel, guys, dividend yield is not the only thing to look at. One thing that I do like to see in B&M is that since 2015, so every single year, they have managed to increase their dividends with a massive jump here. So I do wonder if that's going to continue into the next year as well. Over the last 1 month, B&M have actually done really well. So they're up by nearly 22%. 6 months, not exactly great, down by over 17%. If we look at the year, again, not a great picture, down by nearly 35%. 5 years down by just under 2%. And if we max it out here, we can see that now wouldn't necessarily be a bad time to buy. It's not right at the bottom, but it's really hard to time that and probably not worth it. But equally, if this is a stock that you think is going to do well in the future and it fills a hole in your portfolio, maybe a sector that you haven't got exposure to, maybe you want to have more recession-proof stocks, that sort of thing, it could be a good idea because it's still not anywhere near its all-time highs. It's still trading at quite a low stock price, than it has been for quite a while. So just taking a look at the PE ratio, we can see that it is quite low at the moment compared to the last 5 years. The high was here at 57 and now it's just over 9. So this could potentially indicate that now is a good time to buy this stock. The next company up on our list today is Vodafone. Of course, this is in the communication sector. Personally, it's one that I've kind of got my eye on. I did a video recently where I spoke about my portfolio and how the diversification on some sectors was lacking, communications being one of them. I don't really have any companies within my portfolio that represent that sector. So Vodafone is definitely up there on my list of what I'm looking at right now. Vodafone have had a pretty rough time recently. Over the last 1 month, down by 4.5%, 6 months, nearly 21%, year to date, 17%, and 5 years, 58.15%. Now, this is a company that's been hit pretty hard by inflation. You know, their costs are rising. But one thing that they have done is they've launched a cost-saving program, which is helping to simplify their operations and hopefully help with saving costs. Their net debt, however, has been sneaking back up, mainly due to the outgoings that they have, the high dividends that they pay, which we'll see in a minute, and some buybacks that they've been doing as well. But again, it's the same argument. Is this a good company to have when times are tough in the market? Businesses, any businesses, and pretty much anyone all across the world now, you know, they want to stay connected. They need their mobile and they need their broadband to work. And this is exactly what this company is providing. If we max it out here, we can see that they're at quite a low point right now. They're trading at 95.7, and I'm just trying to look for the obvious low point that's been in the last sort of 10 even. Yeah. So they are really trading at quite a low price right now. So this could be a great opportunity should you do your research and actually want to add this company. You know, they suit your risk, they suit your portfolio, everything checks out. They've definitely got quite a low share price and they've had for a while here. Another quick thing that I'll just mention whilst we're on Vodafone is they're winning a lot of customers in Africa at the moment. And of course, with rolling out of 5G and whatnot, that could potentially set them up for a good future. But we can't predict it. Vodafone are also a biannually payer, and their yield is really quite high. It's 7.8%. It's not the highest that we've seen, but it's up there. You know, it's definitely one of the UK trusted stocks that have a high yield. Let's just take a look at how they've been doing with their dividends. So we can see that since 2006, increase. Then they've had a knock and they've not really managed to get back up to a high level just yet. The PE ratio for Vodafone right now is the lowest it's been for the past year. Again, potentially could indicate a buying opportunity. The last one up today is Taylor Wimpey, which is the largest home construction company here in the UK. Not personally one that I have in my own portfolio, but I know a lot of investors do. So just taking a look at the performance here, over the last 1 month, they're up by 11%. 6 months down by over 20. 1 year, again, not a great picture here, down by 33.68%. 5 years, even worse, down by 48%. And let's just zoom out now. We can see that they are trading at a share price lower than they have for a while, but definitely not their lowest by any means. They've been declining since about April, and it's kind of reached its lowest price than it has since that point. With this stock, revenue was down by 5.4%. But the operating profit was actually up by 0.1%. What I would say though is that this sector's been hit hard by inflation. The building sector has been hit very hard, but Taylor Wimpey actually managed to increase its operating profit margin from 19.3% to 20.4%. So that's really good to see, especially in current times. There are some positives to say about the future of this company. Their order book, so the amount of orders that they've got in, is worth £2.8 billion, and they've also got a land bank of 88,000 plots. So that's encouraging to see as someone that may want to actually invest into this company. But let me just play devil's advocate here. And on the flip side, you've got to think about the mortgage issues that we're seeing, problems and changes with the government buying schemes, and just inflation in general. You've got the ongoing labour and supply chain challenges that we're seeing. And this sector is seeing a lot of planning permission disruptions. So lots to think about when it comes to this one. If you are an investor that has Taylor Wimpey in your portfolio, let me know your thoughts. Are you glad you bought this stock? Are you going to continue investing into this company? If you've got anything to add, of course, let me know as well. Taylor Wimpey paid twice a year with a very, very high dividend yield of 8.9%. Let's just see how they've been doing. It's a bit of a mismatch here, isn't it? We've got an increase from 2012 up to 2018. Then the dividends got cut, increased a little bit, and then really jumped up again in 2021. And like with all the other stocks that we've seen today, the PE ratio has been falling recently. Could indicate a buying opportunity, but not always. Don't only look at this. So there were 4 UK dividend stocks that are discounted right now that you may want to take a look at. I'm not a financial advisor. This is not financial advice. I'm just sharing what I'm learning as I'm going, as I'm learning more about dividend investing. So if that sounds good to you, give the video a like, subscribe to the channel, and I'll see you very soon with another video.